compounding, and some are stories of hope, struggle, and potential. In today's video, I'll take you through three very different Indian companies: Reganto Enterprises Limited, Enviro Infra Engineers Limited, and Dindigul Farm Products Limited. This is not just about numbers, this is about where these companies came from, where they stand today, and where they could go in the next 1 to 3 years. Reganto Enterprises Limited is the kind of company whose story does not begin with excitement but with neglect. For years, it existed on the fringes of investor attention, small in size, limited in scale, and largely ignored by the broader market. Its business is spread across electronic components, IT hardware, and security related solutions. Was never flashy, never headline grabbing, and perhaps because of that the stock slowly faded into obscurity. Markets have a habit of revisiting forgotten places, especially when changes begins quietly. Somewhere along the line, Reganto began restructuring its operations, refining its focus, and attempting to rebuild itself with a discipline rather than drama. As the stock trades around 11 to 12 rupees and carries a market capitalization of roughly 170 crores, still looks small, almost insignificant at first glance, yet when one slows down and looks carefully, the numbers reveals a company that has moved decisively away from its past. Revenue has grown sharply over recent years, profit have emerged where none existed before, and the compound annual growth rates appear extraordinary. Not because the company has become large overnight, but because it has moved from near irrelevance to visible scale. Promoter continue to hold close to 63% of the company, which signals belief and long-term intent, but the near absence of institutional investors keeps the stock emotionally sensitive and volatile. Valuation remains low, return ratios have improved, and leverage appears manageable. All positive signs, yet the real test lies in the quality and sustainability of cash flows. Turnaround stories are fragile in their early years, and Anto is still walking that narrow path where consistency matters more than speed. If management continues executing patiently, avoids aggressive expansion, and allows earnings to mature into stable cash generation, the market may slowly begin to trust the transformation. In such a scenario, a 1 year target in the range of 48 to 60 becomes reasonable, driven by re-rating rather than speculation, while a 3 years horizon could open the door towards 130 to 185, provided the company proves that this recovery is not temporary but structural. This is not a stock that rewards those who understand that quiet change often precedes visible success. Let's talk about the second stock, that is Enviro Infra Engineers Limited. In contrast, tells a story that feels calm, grounded, and almost inevitable. This is not a company trying to reinvent itself, it is a company steadily growing into its relevance, operating in water treatment, sewage management, and pollution control infrastructure. Enviro Infra sits at the intersection of urban growth and environmental necessity. As cities expand, water scarcity intensifies, and regulatory pressure increases, the services this company provides move from optional to essential. With the stock trading around 180 rupees and a market capitalization close to 3000 crores, Enviro Infra occupies a comfortable space in the mid-cap universe, large enough to be stable yet small enough to grow meaningfully. Promoter holds roughly 70%, offering stability and long-term vision, while the balance sheet reflects discipline through controlled debt and strong capital efficiency. Return ratios such as ROE and ROCE consistently remain in healthy territory, signaling that growth has not come at the cost of financial stress. What truly anchors this story is the company's order book, a steady pipeline of water and environmental infrastructure projects worth hundreds of crores, providing multi-year revenue visibility. Over the past several years, both revenue and profit have compounded at a strong double-digit CAGR rates, and importantly, this growth has occurred at scale, not from a negligible base. Infrastructure businesses are never without risk. Delays, working capital cycles, and execution challenges are part of the landscape, but EnviroInfra has demonstrated an ability to navigate these challenges without compromising margins or balance sheet strength. If this discipline continues, and India's focus on water and environmental infrastructure remains intact, the company's growth trajectory appears steady rather than speculative. In that context, a 1 year target of 340 to 360 reflects measure valuation expansion, while a 3 years horizon of 780 to 820 represent the power of consistent compounding. This is not a story of sudden excitement, this is a story of patience being rewarded quietly year after year. Talk about the last stock, that is Dindigul Farm Product Limited. There is a very different emotional weight, the weight of uncertainty, struggle and possibility. A microcap operating in dairy-based ingredients such as milk protein concentrate and whey products, the company functions within one of the most challenging segments of the food processing ecosystem. Input costs fluctuate, margins remain thin, and scale determines survival. Trading around 13 to 14 rupees with a market capitalization of barely 35 crore rupees, Dindigul Farm product exists at a level where every operational decision matters. Every inefficiency shows up immediately in the numbers. Promoter holds close to 59%, indicating continued commitment, while limited institutional participation keeps liquidity low and volatility high. Financially, the challenges are evident. Revenue have grown in phases but lack consistency. Profitability has been under pressure, and return ratio remain negative. This is not yet a company that has found operational stability, yet the broader environment offers a quiet tailwind. Government budgets and policy initiatives continue to emphasize dairy development, food processing infrastructure, MSME financing, and rural value addition, all of which slowly improve the ecosystem in which companies like Dindigul operate. For a business this small, even modest improvements in capacity utilization, cost control, or demand stability can dramatically change outcomes. The CAGR potential here is not visible in the past but implied in the future if execution improves. This is not a story certainty of optionality. If management manages to stabilize operations and move towards consistent profitability, the market may begin to reassess its pessimism. In such a case, a 1 year target of 50 to 60 rupees becomes possible, driven more by sentiment shift that earnings strength, while a 3 years horizon of 230 to 235 would depend entirely on sustained execution. This is a high risk narrative suitable only for investors who understand that smallest companies often demand the greatest patience before they speak. So here is the final takeaways. EnviroInfra engineers the compounding story, Reganto Enterprises the turnaround story, and Dindigul Farm products the speculative comeback story. Market don't just reward growth, they reward consistent execution. Choose your story based on your risk appetite, not excitement. This is not investment advice. Always do your research. Thank you for watching. See you next. Thank you. Bye bye.